Cryptocurrency was founded on a promise of a new financial system, one that was open, borderless, and democratic. A system that would strip power away from central banks and large institutions and return it to the people. This promise of decentralization was its revolution. It was the core idea that brought millions of believers into the fold. But that was the promise. This is the reality. A reality where power is not distributed but concentrated. A reality where a small select group of players now exerts more influence over this multi-trillion-dollar ecosystem than any single entity ever could in traditional finance. The founding ideal has become its greatest myth. This is not a story about price. This is an investigation into control. This is the truth about who really governs the world of cryptocurrency, why the average investor has far less power than they are led to believe, and what this means for the future of your wealth. The story begins with a vision. In 2008, an entity known as Satoshi Nakamoto introduced a white paper. It was not merely a proposal for digital money, it was a declaration of independence from a broken financial system. The core idea was radical in its simplicity, a peer-to-peer electronic cash system. No central authority, no intermediaries, no permission required. This vision was built upon three unwavering pillars. First, decentralization, a network maintained by its users collectively, not by any central server or company. Second, censorship resistance. No government or bank could freeze accounts or reverse transactions. And third, permissionless. Anyone, anywhere could participate without asking for access. It was a promise of pure democratic finance, a system by the people, for the people. But ideals often collide with reality, and the reality we see today tells a very different story. The underlying code remains decentralized. But the power, the tangible, market-moving, decision-making control has become fiercely concentrated. The revolutionary distributed system has given rise to new giants, new intermediaries, new central points of failure. This presents us with the most critical question, the one we will answer in this investigation. If it is not the people in control, then who exactly is pulling the strings? Before we reveal the key players, we want to hear from you. Let us know in the comments. Did you initially embrace cryptocurrency for its promise of decentralization? The whales, the owners. The first group we must examine are the owners. In the traditional financial world, wealth concentration is a well-documented phenomenon. Cryptocurrency, despite its egalitarian promises, has not only replicated this problem, but in many cases has exacerbated it. Data reveals a startling concentration of ownership. It is estimated that approximately 2% of all wallets control over 95% of the entire Bitcoin wealth. This distribution mirrors and often exceeds the wealth inequality seen in the traditional global economy. These large holders are known as whales. The influence of these whales is not passive. Their substantial holdings grant them the power to manipulate markets. They can create artificial price floors or ceilings by placing massive buy or sell orders, a tactic known as building whale walls. These visible walls on exchange order books can trigger panic selling or fuel frenzied buying among smaller retail investors, allowing whales to profit from the volatility they engineer. Furthermore, in networks that utilize proof-of-stake governance models, wealth directly translates to voting power. Large holders can single-handedly influence decisions on protocol upgrades and changes, steering the future of a blockchain to serve their own interests. This creates a system where the principle of one person, one vote is replaced by $1, one vote. The conclusion is inescapable. The first pillar of control is ownership. A small, wealthy elite holds disproportionate power to move markets and guide development, fundamentally challenging the notion of a democratized financial system. The miners and validators, the gatekeepers. If the whales control the wealth, then the second group controls the very integrity of the network itself. These are the miners and validators, the entities responsible for processing transactions and securing the blockchain. In theory, this group should be a vast, distributed crowd of individuals. In practice, it is a highly concentrated industry. The security of a proof-of-work blockchain like Bitcoin is meant to be guaranteed by a global, decentralized network of miners. However, the reality is that a handful of large mining pools control the overwhelming majority of the total computational power. Just 2 or 3 pools often account for more than 50% of the entire network hash rate. This level of concentration introduces a critical vulnerability. If these pools were ever to collude, they could theoretically launch a 51% attack, allowing them to halt transactions, reverse them, or double spend coins. The network's security, therefore, rests on the continued goodwill of a few key organizations. The situation is not fundamentally different in proof-of-stake networks, which are often marketed as a more democratic alternative. Here, users are meant to participate by staking their coins to help validate transactions. In reality, the technical complexity and high financial barriers to entry, often requiring a minimum of 32 Ethereum, for example, push most users towards centralized staking pools. Companies like Lido Finance and centralized exchanges such as Coinbase and Binance have become the dominant staking forces. This means a small number of large entities once again hold disproportionate influence over transaction validation and network governance. The promise of a trustless system secured by a distributed crowd has given way to a reality where we must place our trust in the limited number of powerful gatekeepers. The power to confirm transactions and update the ledger is not in the hands of the people, but in the hands of a new class of centralized operators. The developers and foundations, the architects. Beneath the surface of ownership and network maintenance lies a third, equally critical layer of control: the power to define the rules of the system itself. This authority rests largely with the core developers and the influential foundations that support major blockchain projects. Though the code for many cryptocurrencies is open source, its evolution is not a democratic process. A small, dedicated group of core developers maintains the primary code base. Their technical expertise grants them immense influence over the direction of a project. They decide which upgrades to prioritize, which bugs to fix, and which features to implement. While community input may be considered, the final authority on code changes often resides with this limited technical elite. This dynamic becomes starkly evident during moments of crisis. A prime example is the 2016 DAO hack on the Ethereum network. In response, the core developers and the Ethereum Foundation made the consequential decision to execute a hard fork, effectively rewriting transaction history to reverse the theft. This action, while resolving a short-term crisis, demonstrated that a centralized group could alter the immutable ledger, a move that stood in direct opposition to the foundational principle of unstoppable code. These foundational organizations, such as the Ethereum Foundation or the Bitcoin Core Development Group, wield significant soft power. They fund development, sponsor research, and promote their respective ecosystems. Their public statements and endorsements can sway market sentiment and influence the decisions of miners and investors. While they may not have direct control, their centralized influence shapes the very infrastructure upon which the entire decentralized narrative is built. Thus, the architectural future of cryptocurrency is not being designed by a collective of peers. It is being steered by a concentrated group of developers and foundations whose visions and decisions define what is possible for everyone else. The rules of the decentralized world are being written by a very centralized hand. The exchanges, the new banks. Completing this ecosystem of control are the cryptocurrency exchanges. These platforms, which facilitate the buying and selling of digital assets, have positioned themselves as indispensable gatekeepers between the traditional financial world and the crypto economy. In doing so, they have become the new centralized banks they were designed to circumvent. Exchanges like Binance, Coinbase, and Kraken hold immense power through custody. A significant portion of cryptocurrency supply is held not in individual private wallets, but in the centralized wallets controlled by these exchanges. This means these institutions effectively control the assets of millions of users, creating massive, tempting targets for hackers and introducing single points of failure into a system meant to be resilient. Furthermore, exchanges exert tremendous influence over market access and liquidity. They decide which tokens are listed and promoted, effectively acting as kingmakers for new projects. A listing on a major exchange can catapult a token to legitimacy and success, while denial can consign it to obscurity. This power to pick winners and losers mirrors the role of traditional stock exchanges and investment banks, centralizing financial influence in the hands of a few corporate entities. Perhaps most critically, these exchanges are increasingly subject to and intertwined with government regulation. As they become more regulated, they must comply with traditional financial rules, including Know Your Customer, KYC, and anti-money laundering, AML requirements. This makes them extensions of the very governmental oversight that cryptocurrency was created to escape. The promise of anonymous, permissionless finance is filtered through platforms that require identity verification and monitor transactions. In the end, exchanges have not dismantled the traditional financial system. They have rebuilt its centralized architecture within the crypto world, becoming the new intermediaries that stand between users and the decentralized future they seek.